This video is about financing sources and decisions. What is cost of capital? Cost of capital represents the firm cost of financing and is the minimum rate of return that a project must earn to increase firm value. In this chapter, our concern is only with the long-term source of capital available to the firm because these are the sources that supply the financing necessary to support the firm's capital budgeting activities. So what are the sources of long-term capital? If you look at this balance sheet, there are four basic sources of long-term capital for firms, which is long-term debt, preferred stock, common stock, and retained earning. Net proceeds. What is net profit? Net profit funds actually received by the firm from the sale of security. So the total proceeds are reduced by the flotation costs, which represent the total cost of issuing and selling the securities. These costs apply to all public offering of securities, for example, debt, preferred stock, and common stock. So, flotation costs include two components: underwriting costs, which is compensation earned by the investment bankers for selling the securities, and the second one is administrative costs, which is issuer expenses such as legal, accounting, and printing. This is example calculation on net profits. Duchess Corporations, a major hardware manufacturer, is contemplating selling 10 million worth of 20-year 9% coupon bonds, each with par value of 1,000 ringgit. Because bonds with similar risk earn greater than 9%, the firm must sell the bonds for 980 to compensate for the lower coupon interest rate. The flotation costs are 2% of the par value of the bond. So to calculate the net profit from issuing of the bond, you need to calculate the flotation cost of the bond first. So flotation cost, 2% is the flotation rate times the par value of the bond, which is 1,000. So you get 20 ringgit flotation cost. The issuing price or the selling price of the bond is 980. So net profit, issuing price minus flotation cost. So 980 minus 20 ringgit. So you get 960 ringgit. Now we look at the component cost of capital and we look at the calculation for each cost of capital. So we have cost of debt, cost of preferred stock, cost of retained earning, and cost of common stock. Now we look at the cost of debt. Method number 1, using market quotation. It is a relatively quick method for finding the before-tax cost of debt is to observe the yield to maturity, YTM, on the firm existing bond or other bonds of similar risk issued by other companies. For example, if the market requires a YTM of 9.7% for a similar risk bond, this value can be used as the before-tax cost of debt for the new bond. The second method to calculate cost of debt is calculate the YTM of the bond. This approach finds the before-tax cost of debt by calculating the YTM generated by the bond's cash flows, given the net proceeds that the firm received when it issues the bond. From the issuer point of view, this value is the cost to maturity of the cash flows associated with the debt. The YTM can be calculated by using a financial calculator or an electronic spreadsheet. It represents the annual before-tax percentage cost of debt. Okay, so we look at example. Example calculation cost of debt. Duchess Corporation, a major hardware manufacturer, is contemplating selling 10 million worth of 20-year 9% coupon annual interest bond, each with par value of 1,000 ringgit. Because bonds with similar risks earn returns greater than 9%, the firm must sell the bond for 980 to compensate for the lower coupon interest rate. The flotation costs are 2% of the par value of the bond. The tax rate is 4%. So first, you need to calculate the flotation cost. So flotation cost, 2% flotation rate times par value, so you get 20 ringgit. The issuing price of the bond is 980. Then you need to calculate net proceed of the bond. So issuing price 980 minus flotation cost 20 ringgit, so you get 960 ringgit. Then you can calculate cost of debt before tax by using calculation for YTM. So you use financial calculator, clear all the data, you put 20 for N, present value we put 960, which is the net proceed of the bond. Future value 1,000, this is the principal or par value of the bond, we put negative sign. PMT is the payment or coupon payment of the bond, which is 9% times 1,000 ringgit, so you get 90 ringgit. And then compute IY, you get 9.45%. The bond is annual coupon bond, so times with number of compounding equal to 1, so you get 9.45%. This is RD. RD is the cost of debt before tax. Cost of debt for tax, we need to calculate cost of debt after tax because interest payment has a tax benefit. That's why we need to calculate cost of debt after tax. So the formula cost of debt after tax, RI, equal to RD times 1 minus tax rate. So tax rate given is 40%. So 9.45%, the cost of debt before tax times 1 minus 40%. So the cost of debt is 5.67%. Next, we need to calculate cost of common stock for return earning. For method number 1, we can use constant growth valuation model. So cost of stock for return earning is equal to D1 divided by P0 plus G times 100, where RS is the common stock, cost of common stock for return earning, D1, next year dividend of common stock, P0 is the market price of common stock, G is the growth rate of the company. This is example for calculation cost of common stock for retained earning by using constant growth valuation model. Duchess Corporation wished to determine its cost of common stock equity. The market price of its common stock is 50 ringgit per share. The firm expects to pay dividend of $4 at the end of the next year. The growth rate of the company is constant at 5% per year. So you plug in all the information into the constant growth valuation model. So RS is the cost of common stock for retained earning equal to next year dividend $4 divided by market price of share $50 plus growth rate of the company 5% times 100. So you get 13%. The cost of common stock for retained earning. The second method to calculate cost of stock for retained earning is by using capital asset pricing model, CAPM. So the formula for CAPM is RS is equal to cost of common stock retained earning equal to RFR, risk-free rate, plus beta S, beta of the company, times RM is return of market minus RFR, which is the risk-free rate. This is example calculation of common stock return earning by using capital asset pricing model CAPM. Duchess Corporation now wish to calculate its common stock equity by using CAPM. The firm's investment advisors and its own analysts indicate that the risk-free rate is 7%, the firm's beta at 1.5, and the market return at 11%. So cost of common stock by using CAPM model is RFR 7% plus beta for company 1.5 times 11% market return minus 7%, which is the RFR. So you get 13%. Next, we calculate cost of common stock if the company issue new share. So to calculate new share issued cost of common stock, we use constant growth valuation model. The formula is RN. RN is cost of common stock for new share issued equal to D1 next year dividend of common stock divided by NN, and N is net profit for issuing new share plus G is the growth rate of the company times 100. Example calculation cost of common stock new share issued for constant growth model. Duchess Corporation is trying to calculate the cost of new share issued. The company expected to pay next year dividend at $4 and the growth rate of the company is constant at 5%. Duchess Corporation has estimated that on average a new shares can be sold at $47. The flotation cost of new share issued is $2.50. So first we need to calculate net profit from the new share issued. So issuing price of new common share minus flotation cost. So issuing price is 47 ringgit minus flotation cost 250. So you get 45.50. So 44.50. So you plug in into the formula. Next year dividend D1 equal to $4 divided by NN net profit of common share $44.50 plus 5% times 100, so you get 14%. Weighted average cost of capital, WACC. So WACC represent the overall cost of capital for the company. So how to calculate weighted average cost of capital? In earlier example, we found the cost of various types of capital for Duchess Corporation to be as follows. Cost of debt after tax is 5.6%. Cost of preferred stock 10%, 10.6%. Cost of retained earning is 13%. Cost of new common stock issued is 14%. So the company used the following weight in calculating its weighted average cost of capital. So source of capital, long-term debt 40%, preferred stock 10%, and common stock equity is 50%. So we can calculate two WACC for the company. The first one, WACC, if the company plan to use retained earning. That means the company use retained earning only. So if the retained earning is enough, the company will use only retained earning in the company. So the WACC, you get 9.8%. If the return in earning is not enough to finance their business project, the company will issue new share. So the WACC, if the company plan to issue new share, is 10.30%. So that's all about cost of capital and capital structure. Thank you.